Study says U.S. companies pay 25% tax rate abroad. The U.S. has a complicated worldwide system of taxation that requires businesses to pay the 35% federal corporate tax rate on their income, the highest in the world, regardless of whether it was earned domestically or abroad, said tax foundation economist Pomerleau. When it comes to foreign profits, companies pay tax on their income not once, but twice, less a credit for the taxes they pay to other countries. While American firms can delay paying the additional U.S. tax on their foreign profits as long as the earnings are reinvested in the ongoing activities of their foreign subsidiaries, and the additional U.S. tax is only due when the profits are eventually repatriated, the TF explained that companies are still required to report to the IRS on how much they earn in each country they operate in and how much they pay those countries in taxes, as part of their annual tax returns. The TF noted that, while it is undoubtedly true that U.S. multinational firms use tax planning techniques to minimize the taxes they pay on their foreign earnings, American companies paid more than $104 billion abroad on foreign taxable income of $416 billion, an average effective exchange rate of 25%, according to the most recent IRS data for 2009. Furthermore, while the foreign taxable earnings of U.S. companies have grown over the years between 1992 and 2009, so have their foreign taxes. Over those 17 years, the TF calculated that taxable income grew in real terms by 214% and foreign taxes paid grew by 202%. The TF found that the largest concentration of foreign earnings for U.S. multinationals was in the European Union, at $164.5 billion, on which they paid nearly $38 billion in income taxes at an average effective tax rate of 24%. The second largest concentration of taxable earnings was in Asia at $60.8 billion, where U.S. firms paid more than $18 billion at an average effective tax rate of 31%. With regard to particular countries, while the TF also emphasized that the majority of countries at the top of the foreign earnings list for U.S. companies have normal corporate tax systems, there were two so-called tax havens, Bermuda with $25.3 billion in income and the Cayman Islands $9.1 billion within that list. Even there, U.S. multinationals paid average effective tax rate of 17.8% and 20.9%, respectively. However, the TF did calculate that Ireland did, due to its low statutory corporate tax rate, give U.S. companies one of the lowest average effective tax rates at 11% on earnings of $14.6 billion in 2009. People who criticize U.S. companies for avoiding taxes on their foreign earnings need to be more careful with their language and acknowledge that our worldwide tax system requires U.S. firms to pay taxes twice on their foreign profits, before they can reinvest those profits back home, noted Pomerleau. Any discussion about reforming the corporate tax code must keep these facts in mind. Visit our website at www.lavco.com for more information regarding tax optimization strategies. Since 1991 we have been helping our clients with formation of offshore companies in more than 40 locations, in both offshore zones and onshore zones. Offshore bank account opening in the most trustful banks in the world. Secretarial and administrative services, and with formation of offshore trusts and offshore private foundations. Let us help you take the next step and contact us for immediate free information and advice. Visit our website at www.lavco.com or add us to Skype. Our Skype name is lavco_Cyprus, or email us at cyprus@lavco.com.